Indicator-based trading is not fake, but it is badly oversold. The truth about indicator-based trading is simple. Indicators can help you organize price behavior, but they do not predict the market by themselves. That is the part most beginners miss. In a few minutes, I want to show you what indicators really do, why traders trust them, and why so many people still lose money while using them.
First, an indicator is just a calculation built from price, volume, or both. A moving average smooths price so you can see trend direction more clearly. RSI measures whether recent gains have been stronger than recent losses. MACD compares two moving averages to show momentum shifts. None of these tools are magic. They are filters. They take messy price action and turn it into something easier to read. That is useful, but a filter is not a forecast. This is where the story gets more interesting. Traders usually use indicators in one of three ways: to spot trend, to time entries, or to confirm a setup. That sounds sensible, and sometimes it is. A trend trader may want price above a rising moving average. A momentum trader may wait for RSI to come out of an extreme zone. A cautious trader may want several signals to line up. The problem is that once people see a clean signal, they start treating it like a yes or no machine. Markets do not work that way. They change regime. An indicator that looks strong in a trending market can fail badly in a choppy one. That failure point is the real truth. Most indicator-based trading breaks down because traders use the indicator without context. They ignore trend structure, volatility, and the broader market environment. They also overfit. They keep adding one more indicator to fix the last bad trade until the chart becomes a crowded dashboard that looks sophisticated but answers nothing. More indicators usually do not mean more clarity. Often they mean more delay. There is also a hidden incentive issue. Indicators are easy to sell because they feel objective. A line crosses another line and it looks scientific. That makes beginners more confident than they should be. But confidence is not evidence. A good indicator setup still needs a rule for when it is valid, when it is invalid, and what market condition it is designed for. If you cannot explain that in plain English, the setup is probably too vague to trade consistently. So when does indicator-based trading work best? Usually when the indicator matches the job. Trend-following indicators tend to behave better in persistent moves. Mean reversion tools can help in range-bound markets. Confirmation indicators can reduce bad entries if they are kept simple. But indicators tend to fail when traders expect them to call tops and bottoms, or when they try to force them into every market condition. The market is not impressed by a perfect-looking signal in the wrong environment. My judgment is plain. Indicator-based trading is useful as a decision aid, not as a full trading system by itself. The edge, if there is one, comes from combining a simple indicator with market context, risk control, and a clear rule set. The truth is not that indicators are useless. The truth is that they are honest only when you understand what they are measuring, what they are not measuring, and when to stop trusting them.